Our topic today is the revised Form W-4 for 2020. We'll discuss the changes to the form and its calculations, how to deploy it, and what to do in certain cases when a W-4 might be used for reference. So to begin, the 2020 Form W-4 Employees Withholding Certificate is quite a bit different from previous versions. The IRS revised the form to comply with the income tax withholding requirements in the Tax Cuts and Jobs Act. A note of importance: the form no longer uses the concept of withholding allowances to account for additional income, deductions, and tax credits, but includes lines where employees can enter those amounts directly so they can be used to calculate the withholding amount. While the form is different, the IRS designed the withholding tables to work with either a prior year form or the 2020 form. The IRS is not requiring all employees to complete a new form. However, the new form is required for all new hires in 2020 and for employees who have completed a Form W-4 before the year 2020 and want to make changes to their withholding in the year 2020. Also, while employers may not require employees to complete a new form, they may ask them to do so. You'll note in the introduction we refer to Publication 15T and also the withholding calculator. I will show you what those look like as we go on. To begin with, we're going to look at the 4 pages of the Form W-4. Page 1 is what's called the Employee's Withholding Certificate, and this is the section that would be turned in to an employer. As you see, Step 1 is personal information, and Step 1B there is filing status. Steps 2 to 4 are only filled out in certain circumstances, and then Step 5 is the signature and attestation. Very briefly, that's what it looks like. We'll go into those in more depth as we go forward. Page 2 of the form are the general instructions. General instructions are the same as you would see for any other form or publication that the Internal Revenue Service publishes. Page 3 is the multiple jobs worksheet as well as the deductions worksheet. And again, those are optional. We will discuss that when we get to the specific sections. And these are the new withholding tables that we'll be using in the case of anyone who is married filing jointly, or someone who may have a spouse working, or someone that has 2 jobs, or someone that has additional income that they wish to include for withholding. So these are the tables, and as you can see, down the left side, the higher paying job and annual taxable wage and salary is to be selected there. Going across is for the lower paying job and the annual taxable wage and salary for that job. Again, that's depending on the options an employee selects. Breaking the form down into its parts, we'll start with Step 1. Personal information is entered in this section, and the employees must also select the status: single or married filing separately, married filing jointly or qualifying widower, or head of household. And note that it gives you the information of how to qualify as a head of household. You are unmarried and pay more than half the costs of keeping up a home for yourself and a qualifying individual. So Part 1C contains the filing status. So this is what I referred to earlier. Step 2, these steps are to be completed only if they apply. If the employee has multiple jobs, or if the employee is married filing jointly and the spouse works. And we'll get to page 3. As you see, I mentioned page 3 there, so we're going to skip to that and then come back here. So reading through, you'll see it says complete steps 2 through 4 only if they apply to you. Otherwise, skip to step 5. So step 2, multiple jobs or spouse works. Complete this step if you hold more than one job at a time or are married filing jointly and your spouse also works. The correct amount of withholding depends on income earned from all of those jobs. And then the next instruction, do only one of the following. Use the estimator for most accurate withholding for this step and steps 3 or 4, or use the multiple jobs worksheet on page 3. Let's look at that right now. The multiple jobs worksheet begins by saying, if you choose the option in step 2B on Form W-4, complete this worksheet, which calculates the total extra tax for all jobs. You're doing this on only one Form W-4. Withholding will be most accurate if you complete the worksheet and enter the result on Form W-4 for the highest paying job. There's a note. If more than one job has annual wages of more than $120,000 or there are more than 3 jobs, you'll need to refer to 505, Publication 505, for additional tables, or you can use the online withholding estimator, which we will refer to again. So let's look at 2 jobs first. If you have 2 jobs, or if you're married filing jointly and you and your spouse each have 1 job, find the amount from the appropriate table on page 4. You'll remember we looked at that earlier, so let's go back and look at it again. You're going to select the higher paying job from the left and then the lower paying job going across the top. You'll see that my pointer right now is at the level of $80,000 to $80,999. So using as an example a higher salary of $100,000 and then the second salary of between $80,000 and $89,000, the annual tax there is $12,900. So that's what you would have to do if you opt for this method. Okay. Sorry, I skipped right past it there. Okay. So if you are using 2 jobs, you would enter the dollar amount there on line 1 and then skip to line 3 as it says. So that number might be the $12,000 number that we saw on the table. Skipping to line 3, you'll see it says enter the number of pay periods per year for the highest paying job. For example, if that job pays weekly, enter 52. So my payroll people, I'm sure you're aware of this. For biweekly, that number is 26. For semi-monthly, that number is 24, and so on. You would put that number here in space 3, and then you would divide the annual amount on line 1 by the number of periods in line 3, and that will give you the per pay period withholding amount for this W-4 for this employee, which should be the higher paying spouse. All right, skipping back to where we were. So in step 2, we're going to imagine that we have used that multiple jobs worksheet and we've entered the result. And if there are only 2 jobs, you may check this box, and then the employee who fills out the W-4 for the other job would do the same. That is, again, up to the couple involved. If you are filing jointly and both spouses work, you may choose to do that, or you may choose to come up with an estimate. You may be able to understand what your estimated tax may be based on previous filings. So if you are completing steps 3 through 4B, you're going to do that for only 1 job, and then you can leave the other steps blank. As we go forward, we'll see if we can make more sense of that. So steps 3 and 4, you may claim dependents now. If your income will be $200,000 or less, or $400,000 or less if you are married filing jointly, you may multiply the number of qualifying children under age 17 by $2,000. Multiply the number of other dependents by $500. Qualifying dependents, qualifying children are under age 17. However, qualifying dependents are those that might be children over the age of 17 living with the employee or parents. You will need to refer to Publication 972 for more information on qualifying dependents. To qualify for the $2,000 child tax credit, the child must be under age 17 as of December 31st, must be your dependent who generally lives with you for more than half the year, and must have the required Social Security number. The other claim, the $500 dependent claim, you may be able to claim that credit for dependents whom a child tax credit can't be claimed, such as an older child or a qualifying relative. So Publication 972 will give you the information about that. So if you wish to claim dependents, you will put that here. Now for step 4, you may also opt to add adjustments. And in that case, you may include other income, not from jobs. If you are getting dividends or interest for which are taxable and they amount to enough money that they will incur a liability, you may want to include an estimate of that in number 4A. In step 4B, if you want to itemize deductions because you expect to claim something other than the standard deduction, and many people do, and you want to reduce your withholding, use the deductions worksheet on page 3 and then enter the result right here in 4B. Let's take a quick look at that again. I know we're skipping back and forth, but I want to be sure that you know all the parts of the form. So right here is the deductions worksheet, and you'll see that the standard deduction is here, which is $24,800 if you're married filing jointly or if you are a qualifying widower, $18,650 if you're a head of household and qualify as such, or $12,400 if you are single or married filing separately. If you itemize deductions and you estimate those deductions and they are more than those standard deductions, you can enter your estimate of your itemized deductions in line 1. Line 2 would be the standard deduction, and then line 3 you're going to do the comparison. If line 1 is greater than line 2, subtract 2 from 1, and if line 2 is greater than line 1, enter 0. If you have student loan interest, deductible IRA contributions, and certain other types of adjustments, and you will have to refer to Schedule 1 of Form 1040 for that, or publication 505, you can enter that there, just an estimate. So you're going to end up estimating what your itemized deductions might be. If you have a large amount of itemized deductions, as you've used in the past, you may want to go through this deductions worksheet and see if your itemized deductions estimate exceeds the amount that you would get as a standard deduction, which you're probably familiar with. That is the next step here. And you can add lines 3 and 4 then, in other words, the estimate of your deductions of 1 and 2, and then the estimate of your loan interest, your deductible IRA contributions, certain other adjustments which you will need to look up. And then you can enter that result here and then take it back to your deductions amount, which is 4B, step 4B. Step 4C allows you to enter a dollar amount for additional tax you want withheld each pay period. If you want an additional flat amount to be withheld because you've gone through the steps and you think you may be under withheld, you can opt to put a dollar amount per pay period here. So an additional $1,000 a year comes out to a specific amount per pay period. Enter that right here. So again, this is helping to create the calculation of the employee's withholding. And if the employee has multiple jobs, this form should apply to the highest paying job only. And then you'll note also the difference, as we mentioned, between dependent and qualifying children and or other dependents. So that is step 3 and step 4. Okay, as we mentioned, we're referring to this multiple jobs worksheet and also the deductions worksheet. Now, these you would not turn in, but you will probably need to refer to it. So when you fill out the form, you would return page 1, and if you have filled out this section, you should keep it for your records. Again, reiterating what we discussed about the number of qualifying children and other dependents. There are no withholding allowances, but these are the dependents that you can claim right here in steps 3 and 4. No more withholding allowances. Now, something else, if the following conditions are met, and an employee may claim an exemption from withholding, and that exemption would be claimed by simply writing the word exempt in the space below box 4C, right here. Now, the conditions are as follows. If the employee owed no federal tax in the prior year, which is 2019, and the employee also expects to owe no federal tax in the year 2020. This does not mean that the employee received a refund, but that the employee had zero liability. Zero. That's the only condition that an employee should use to claim an exemption from withholding. If the employee can meet both conditions, she or he may write the word exempt in the space below the box 4C. And a reminder, any employee who claims exemption from withholding must submit a new W-4 form each year. The exemption is only for the calendar year in which the form is submitted. So you'll remember we discussed earlier that employees were not required to fill out a new form W-4 if they had a valid W-4 form in place from a prior year. one of your employees filled out a W-4 for 2019 that had the word exempt, and that person claimed exemption from withholding, that form was valid until December 31st, 2019. It is no longer valid. The employee needs to file a new W-4 with the word exempt if he or she wishes to continue having zero withholding for the year 2020. That form is good only for the calendar year in which it is submitted. All right, let's run through this again. The multiple jobs worksheet. Selecting 2 or 3 jobs, the employee then refers to the tables on page 4 to arrive at the total withholding for the year, and then in number 4 divides that number by the number of periods in the year so that you come up with a per pay period amount for withholding. And again, this is only if the employee opts to fill out these steps. If there are multiple jobs involved or if the employee is married and filing jointly. I can't stress enough how important it is to remind employees that they should speak with a tax professional. Even if it's someone that has helped them with their income tax in the past, or if they've gone to a service to have their taxes prepared in the past, they may want to consult with that person again to ensure that they're being covered. No one really wants to end up owing money at the end of the year. With the changes to the tables and the changes to the way this form has been created, it is advisable that everyone, at the very least, use the calculator that we're going to talk about in a little while. At the most, go to someone and have them help you figure out how much you will need to pay in withholding this year so that you can fill out the form appropriately and have your withholding done on a per pay period basis. So again, if you're choosing the 2 or 3 jobs, if you have 2 jobs or you're married filing jointly and you and your spouse each have 1 job, find the amount from the appropriate table. We looked at that earlier. Using the higher paying job row and the lower paying job column, find the value at the intersection of the 2 household salaries and enter that value on line 1. That is true bureaucratic speak, but I hope that I have shown you what it meant by going through that on the table earlier. And don't forget to include the appropriate frequency. Make sure that the employee has the appropriate frequency here in line 3 of step 2B. 24, 26, 52, whichever it is. If they are paid monthly, it's 12. Whichever it is, to ensure that the employee has the appropriate amount withheld per pay period. And again, we looked at this also. Employees may enter an estimate of their itemized deductions and compare it to the standard deduction. Comparing the two, the employee can complete this section of the worksheet. Again, voluntary if he or she chooses. You may wish to go ahead and not itemize, in which case their withholding will be based on the standard deduction here. So we looked at page 4 already on the tables. You can refer to this whenever you wish because the form is widely available now. It was difficult to obtain earlier. It is now widely available. Step 5 is the signature and date. The form is invalid if there isn't a current date and signature. And that current date means not a future date, but it should be dated the day that it is submitted to the payroll or HR team, not before. Publication 15T is new this year, and it supplements Publication 15, the Employer's Tax Guide, and Publication 51, the Agricultural Employer's Tax Guide. It describes the calculation of withholding using the wage bracket method or the percentage method. Remember that those tables were always in Publication 15. They've been moved to 15T. Make sure that your vendor or software provider has made the appropriate changes to the program for withholding calculations, as well as the front end. In other words, entering employee elections from the form. Suppose your software provider or your IT team has created a front end so that employees can use a self-service module and enter their own W-4 information, which is uploaded directly to your payroll system. If they were set up with the old W-4 information, it's no longer valid. They would have to create the new tables and also create a front end that mimics exactly what we saw on this form. Okay, I see a question there. Can the question wait until we get to the Q&A period, or do we need to answer it now? We can answer all questions at the end. I hope that will be okay. All right, so these are the questions that you need to be sure of if you're using either an outsourced vendor or your own IT group is doing this. You have to verify that the vendor or the software has been tested for all iterations of the new tables. Have the brackets been revised? Are the calculations in place for a default W-4? Or for 2020 withholding on previous employees who have not submitted a new W-4 for 2020. This is where you would test to see what various scenarios will bring and to test it against one of the calculators. And just a reminder, always run your own tests wherever you can and as often as you can to be sure that the withholding is appropriate. Now, this applies to regular periodic withholding. It doesn't apply to supplemental wages, nor does it apply to anything other than regular periodic withholding for salary. Supplemental wages have their own rates. Those also, at least one of them has been changed. Actually, I'm sorry, both have been changed. The optional rate and the mandatory rate have both been changed, so you should be careful about that. If you pay supplemental type wages, commissions or bonuses or anything else that requires a separate notification and a separate reckoning in payroll. Regular pay is one thing. Supplemental pay can be recognized separately on a separate pay statement, or it can be included with regular pay. That is your general practice, but you need to ensure that the withholding is appropriate. So here is one of the things we refer to. If you're a small employer and you don't use a payroll provider to calculate your gross to net, or if you need to make an ad hoc calculation or a one-time payment, here is a calculator that the IRS has created. This can actually, if you click on this link, you can open the calculator in Excel, and it will allow you to create the appropriate calculation for whatever scenario you need to create. Comes in very handy. So let's take a look at a couple of other situations that may arise. First of all, withholding on pension payments, the W-4P. Withholding from periodic payments of a pension or an annuity is calculated the same way as withholding from wages, except that it doesn't matter if the W-4P is from 2019 or an earlier earlier or a 2020 Form WP. If you choose, you can go to 15T and use Worksheet 5 and the percentage method tables, or if you like the wage bracket method better, you can use Worksheet 3 and the wage bracket tables to calculate what that pension payments taxation might be. There are options for you here, but in all cases you need publication 15T. And at the end of that section, you see if the recipient doesn't submit W-4P, you must withhold on periodic payments as if the recipient were married, claiming 3 withholding allowances. Another thing that may have cropped up already, if those of you who have a larger employee population, if you've received a lock-in letter from the IRS. Now, a lock-in letter is what happens when the IRS recognizes from W-4s that an employee is severely, shall we say, under-withheld. If an employee is severely under-withheld, very often the IRS will ask for certain copies of employee W-4s, or they will simply look at the employee's past few tax returns and compare the withholding to the income and figure that that is a severe shortcoming. And that shortfall is going to be addressed by a lock-in letter. And that lock-in letter is going to be addressed to the employer. The employer is then required to give a copy to the employee, but the letter will also carry a date, and that effective date will require that the employer begin using a specific withholding status for the employee, regardless of the employee's wishes, because of that serious under-withholding situation. Right? So if you had received a lock-in letter somewhere before January 1st, 2020, then you should continue to follow the instructions in the lock-in letter. You'll use the withholding methods described in 15T for an employee with a Form W-4 from 2019 or earlier. And you should continue following the instructions in the pre-2020 lock-in letter until you receive a letter releasing your employee from the lock-in procedures. You cannot change that withholding from the lock-in letter except in one circumstance. Well, 2 circumstances. One circumstance is that the IRS sends you a letter modifying the original procedure that they had requested. And number 2, your employee gives you voluntarily a new W-4 which ends up with greater withholding than the lock-in letter specified. You should always go to Publication 15 to take a look at what the lock-in letters mean and what the details are on any compliance that's required from you. But I've given you the basics. The letter will give you the employee's name, address, and Social Security number. It'll give you an effective date, and it will tell you exactly how many allowances or what the employee's withholding level should be. Since there are no more allowances, the phraseology will be different, but you will get the message And if the employee is severely underwithheld, which is usually the case when these letters arrive, this will raise the employee's level of withholding, and when the IRS is satisfied, or the employee gives you a form that will increase the amount of withholding over the amount the IRS requested, then you may go away from the lock-in. But until then, you must keep those procedures in place. We touched on new employees before. So any employees who began after 2019 or first received wages after 2019 must use the redesigned form. And, of course, any changes at this point for existing employees also must use the new form. However, if a new employee starts in 2020 and didn't file a W-4 with the payroll team, they will be treated as if they had checked the box for single or married filing separately and then made no entries in step 2, 3, or 4, which means essentially that the employee is being taxed as though they were single and that whatever salary and whatever pay period is on file for that employee. Now, if someone was previously an employee and was paid wages in 2019 and failed to furnish a W-4, should continue to be treated as single and claiming zero allowances on a 2019 W-4. A little paradoxical, but look it up. It is possible. The best method of dealing with this is to ensure that every new employee fills out the form, and any previous employee for whom you cannot find a valid W-4 or the W-4 information on file from 2019 and before does not match the form that you have that person fill out a new form, just to be sure. So, state withholding. Now, if you are a multi-state employer or you happen to work in one of these states, you know that certain states have historically used the federal form W-4 to calculate state withholding. Since the 2020 Form W-4 has no allowances, the states need to come up with new methods of calculation. So, if you are involved in any of these states, this is the information that we have as of this week. The states that have decided to use the federal W-4 for state withholding are those four: Colorado, New Mexico, North Dakota, Utah. The state of Pennsylvania stands by itself because they do not use a withholding certificate, because they have a flat percentage and it is a gross income tax. There is no need for a certificate because the tax is the same regardless. Now, there are many states who formerly permitted the federal form to be used for state withholding. And now many of those, including California, Delaware, Minnesota, Nebraska, New York, they have now mandated the use of their own form for state withholding. So in those cases, if you are in any of those states, and that actually includes the majority of states that have income tax withholding from salary, you need to go to the tax department's websites in those states and find out what is the latest information on their forms, because they may change those. More than likely, most of them were not satisfied with the level of withholding they would receive, or there was no clear path to develop withholding calculations based on the new Form W-4, so they had to require, I know that in many of these states they already had Forms W-4, the state equivalent, in place, but they did not require employees to use them. Some states would say, well, we can default from the federal to the state. If you choose single with one withholding allowance for Minnesota, we can allow that to default over to, a federal single with one can go as single with one for Minnesota also. Minnesota may have figured out that at some point they were going to end up receiving less in withholding and said, well, we can no longer allow any default. That form, the Minnesota MW5, I believe it's called, has to be filed, or they will simply come up with an alternative, which is to say if you do not file a form, you will be treated as single with zero allowances, which is going to be the highest level of withholding. That is the state's prerogative, so it is important to ensure that you know what the current withholding forms look like for each of the states where you do business. Now, of course, there are still 9 states that don't impose a tax on wages. Those of you who are in those states, which include Texas, Tennessee, Nevada, you don't need to worry about this, but those of us who live in states that do require income tax withholding at the state level know that you have to be careful of this. So again, just be sure to verify the status of your state's withholding forms before you give that to employees. Just make sure that you have the most up-to-date form. All right, we can summarize now. And again, the results of completing the form are not allowances, but dollars to be withheld. All employees are not required to fill out the new Form W-4, but I would say that it is a good idea to request it. Now, any employee who is first paid in 2020 does have to submit that form. And the rules that apply for employee withholding generally also apply for periodic pension payments. Remember, we're talking about periodic, not single lump sum payments of a distribution, but periodic payments. Review the lock-in letters, paying particular attention to when they were received. And if you are in a state or states that have income taxes, make sure you have updated to the state's latest withholding allowance form.